So my presentation is going to be about a survey that we do annually. And what we do is we write to all the hotel chains who are present in Africa or looking to be in Africa, and we say to them, tell us about the deals that you have signed with investors / developers for new hotels in Africa, okay? And we get responses from nearly 50 chains. And this year, those 50 chains, between them, have in their development pipeline, so these are hotels that have yet to open their bricks and mortar and their piles of paper, it depends on where they've got to. And between them, these guys had 417 hotels in their development pipeline in the 54 countries of Africa, and nearly 73,000 rooms in the development pipeline. Of those, you can see there the split between Sub-Saharan Africa and North Africa. North Africa we call 5 countries, Egypt across to Morocco. You can see that over the last 5 years, North Africa has been a bit steady Eddie, in the order of 24,000 rooms in the 2017 survey. But of course, remember that there are hotels which were in the pipeline before, which have now opened, so you need to dig into the stats a bit. You can also see that Sub-Saharan Africa now is more than double the North African. Not surprising, because there's 49 countries involved there. Okay. This is where it's happening. This is the breakdown of Sub-Saharan Africa, West, Central, East Africa, and Southern Africa. Majority of activity there is in West Africa, or rather the largest proportion, and I'll show you where in West Africa in a minute. And then Southern Africa is the next largest. Within Southern Africa, though, we've got Angola. And in Angola, a couple of years ago, 2015, one company, Accor, signed the mega deal, 50 hotels, either under construction or in planning, with one company in Angola. So that's quite a big slice of Southern Africa, although South Africa's in there as well. I'll show you in a minute. East Africa, we heard a lot this morning about East Africa rising, and that's what that's all about. Central Africa, Cameroon, DRC, Central African Republic, not a lot happening in terms of new deals being signed. So country-wise, I hope you can all see that. Country-wise, this is what's happening. Now, I said at the beginning that these are deals that have been signed, so pieces of paper that have been signed by the chains on one side of the table and the investors, developers on the other side of the table. So they could all be heaps of paper, but, so what we do is we also look at the proportion of the development pipeline that is actually under construction here. And you can see from this that Egypt, it doesn't have the largest pipeline. Nigeria has that #1 spot in terms of number of rooms in the pipeline. But then in terms of rooms actually under construction, Egypt becomes #1. I hope you're able to follow this. So there's 7,355 rooms under construction in Egypt, only 4,300 of the pipeline in Nigeria. So in other words, it's actually happening more in Egypt than it is in Nigeria. Does that mean Nigerian deals aren't happening as much? Well, maybe they're younger deals, therefore they're not perhaps due to go on site yet. It's interesting that 4 of the 5 North African countries are in the list. we've got Egypt at the top, Morocco, Tunisia, and Algeria. Libya used to be in that list, but so many deals have been cancelled, and I don't think any new deals are actually being signed. Angola, I mentioned, down there, is in the top 10. And for the first time since we did this survey, South Africa actually enters the top 10 slot. There weren't that many deals being done because of the overhang from the 2010 FIFA World Cup. But it's nice to see that more deals are now being done here in South Africa. More important than countries, let's look at cities. If anybody's surprised about that Lagos and Abuja are in the top 3, they weren't listening this morning. It's Nigeria, Nigeria, Nigeria. Cairo, a lot of deals have been signed for Cairo. Still a lot of enthusiasm for Cairo despite the political turmoil there. Addis Ababa, no surprise there. Algiers, though, Sousse in Tunisia, that's mostly resorts, as is Sharm el-Sheikh. Kampala and Nairobi, we heard about Uganda, Kenya this morning. But the big 3 there, Abuja, Cairo, and Lagos. Who is doing this? I mean, most of the usual suspects are in that list. It's interesting, on our panel we have representatives from Hilton and Carlson Residor. They've been chasing each other at the top of this table, or ever since I started it back in 2009. But sorry Hilton, sorry Carlson Residor, this year you slipped to numbers 3 and 4. Why is that? Accor did that mega deal, 50 hotels with 6,000 rooms. So they kind of leapfrogged here into number 2. Marriott, some of you will know that Marriott actually acquired Starwood last year or the year before. It took so long to do, I can't remember. So Marriott is actually a combination of 2 giants, Marriott and Starwood, and they 100% are in the number 1 slot in terms of doing deals. Best Western, then Louvre, that's mostly Golden Tulip. IHG is Intercontinental Hotels Group, which also has the Holiday Inn brand. Quite surprising in some ways. Holiday Inn, everybody's heard of Holiday Inn, one of the biggest brands, but they've actually only got 7 deals in the pipeline in the whole of Africa. Interesting. Now this talks about what's actually happened between 2010 and 2016. Actual openings of branded hotels in Africa, the 54 countries of Africa. Quite a pickup, wasn't there, 2015, 2016. I think just as momentum was building up. 2017 already, beg your pardon. 2017 onwards, these are what the chains estimate are going to open in 2017, 2018, etc., etc. This is what they told me beginning of year. We're going to open 14,000 rooms in 2017. Now this is where the slightly negative point comes in. In 2014, the chains told us that they were going to open 4 times that figure. They told us that they were going to open 14,000 rooms, and they didn't. Their expectations were too optimistic. They actually opened 3,500. 2015 got a bit better, but they said they were going to open 3 times that number. Okay? We're getting better. 2016, this is 47% of what they said they were going to open. So they said they're going to double. Now, we're going to explore this a bit in the panel, but of course the thing to remember now is that the chains, Hilton, Carlson, Residor, Marriott, they don't build hotels. They sign deals with people to build hotels for them that they're going to brand and mostly they're also going to manage them as well. So it's not the chain's fault that these figures fell short of expectations. We'll talk about why it happened on the panel. And then this is what the top 10 chains opened since 2010 to 2016. Accor opened, I think, 50 hotels, mostly in North Africa. They have some big development deals in Algeria and Morocco. Louvre, that's primarily Golden Tulip hotels opening. Carlson Residor, number 3 there with 2 brands, Radisson, Blue and Park Inn. Mövenpick have only 1 brand. They tend to have some big hotels. Marriott, of course, that also takes into account Starwood. That's Marriott, it's Ritz-Carlton, it's Sheraton, it's Ford Point. 30 brands in that stable there. Marriott. Hilton leading with their Hilton brand, plus Hilton Garden Inn, and a few, Conrad. Okay, and finally, this really isn't, I mean, what this shows is the deals left in the pipeline today. This doesn't mean that there was only 1 deal signed in 2007. These are... Just speak on the mic because I can't hear you. Sorry, I can't hear you.
The people at the back.
Really, at the back? I'm really sorry about that. Beg your pardon. Okay, this doesn't mean there was only 1 deal signed in 2007. These are the deals left in the pipeline. But what you can see is that there was less activity in 2016 than there was in 2015. And I wonder why that was, and I hope our panel's going to explain some of that. But encouragingly already, this was just the first couple of months of 2017 that a few hotels. The big issue I have in this pipeline is that there were deals, in this chart, there were deals signed here which are still not open. Why are they still hanging around in this pipeline? Deals that have been signed, and some of them are under construction. I wonder why they're still not been opened. Okay, that's the presentation to set the background of what's happening in terms of the chain hotels. Further ado, I'm going to invite my 3 panelists up. Xander Nynens from JLL. Andrew McLaughlin from Carlson Residor Group. And Mike Collini from Hilton Group. The one thing, or one of the things these guys has in common is that they're all based in Cape Town. Right. Okay, so quite a few tidbits that you might want to comment on as we go along. I don't know if you were here this morning. There were some excellent presentations and panel sessions about real estate development in Africa. And it's concentrating primarily on retail and offices, and to a little extent on industrial parks, and not really on hotels very much. But one of the words I wrote down taking away from this morning was caution. Cautious approach to real estate development in Africa. You guys haven't been cautious, have you? I mean, look at the number of deals that have been that you're doing. The pipeline existing today is 13% up on last year. I'm going to ask you first, Mike, just to introduce Mike Collini from Hilton is actually the new kid on the block because he only moved to Africa in January. Is that right? January this year. Yeah. Having spent many years between Turkey and Russia and other places in Eastern Europe. So I'm going to ask you, Mike, you see this activity, you see this data, you see what your own company's doing when you arrive, you're flown in from Istanbul. Are we cautious? Are these numbers big compared to what you've seen before? What's your impression of Africa as a new boy?
I think it's the reality of an emerging market. I mean, a lot of this is no different to what we experienced in Turkey, Russia, and Eastern Europe. There I was responsible for 21 countries, 2 strategic markets, but with the bulk of the other countries, a variety of economies and countries at different phases of economic growth, different political stabilities, and I think those 2 factors impact on the pipeline. I mean, I'm sure I'm speaking for Andrew as well here. When we sign a deal, we sign a deal confident that it's a genuine deal. We've done our research, we've employed, or the investors employed hotel consultants like you and Xander, and you know, we've done our due diligence, we've evaluated title, the finance is there. The reality then of building the hotel in many of these markets is challenging. I'm a QS by profession. Building, construction and development is not an easy task. And you take that to some of these markets where there's a lack of experience, there's a lack of resources and specialization, that ultimately impacts on the pipeline. But I think that the overriding political and economic stability in some of these markets, I think, has the direct impact. I saw it in Russia. When the ruble collapsed, some of our hotels were frozen for a period of time. So when we look at the history here, I'm sure that's very accountable for some of these countries.
At the beginning of the year, Hilton had a pipeline of just over 9,100 rooms. It probably different today.
It's slightly gone up, yeah.
Yep.
With a few more signings.
What's your, again, as kind of an outsider, okay, you're an insider now, but that was when you arrived, 9,100 rooms. Did you look at that and say, huh, that's a lot? Or did you look, say, 54 countries? That's not very much.
I looked at that and I thought 49 countries, because I'm only responsible for the bottom half.
Africa, yeah.
And I think what a world of opportunity.
Right.
And you know, we've got a strategic focus to accelerate that. And I see the potential, I see the opportunity. I see some challenges, but I'd rather talk about the opportunity.
Right, okay. Andrew, same to you. Cautious. Caution was the watchword this morning about real estate development. Now, I know you're not real estate developers. You're brand managers, you're operations managers. Are you exercising any greater caution today in your quest for more deals?
I think we go through a more stringent sort of due diligence process, but that's not got to do with the way we're doing business in Africa. As a company globally, we just go through a lot more sort of due diligence today than we did a couple of years ago. I think the hotel sector is quite different to some of the other real estate sectors. So guys that were building big shopping centers or big office buildings, and assuming they could take the South African model and put it into Nairobi or put it into Ghana or Nigeria. And the reason it's caution now is the growing middle class that they assumed that they were going to attract from a shopping center point of view is quite different to the hotel sector. So we're still able to charge in foreign currency or price in foreign currency. The scale of the developments are a lot smaller than a 20,000 square meter shopping center, and there's still a sort of undersupply of quality hotels in a lot of countries in Africa. So we're still quite bullish about Africa. We'll be strategic and just make sure we do all our homework before we go into a new market. But we see ourselves accelerating and not sort of slowing down from an African development point of view. There's a lot of opportunity.
Okay, and in terms of your pipeline, which again at the beginning of the year was about 7,800 rooms. Where would you like that to be? Is that about right for you? Or?
Yeah, so we have a goal by the end of 2020 to have 23. So we have 16,500 rooms open or under development in Africa today. By 2020, we want to have 23,000 rooms in Africa. This year, we've opened 5 hotels. We're due to open another 2 before the end of the year. So we're actually delivering on our pipeline. And from now to the end of 2020, we expect to add a new hotel to the continent every 37 days. And we've been able to do that for the last 2 years, and we'll continue to do that. So we would like our pipeline, at the moment we're almost 50-50 as in open under development, and sort of going forward, ideally we would like the pipeline to be less complete greenfield and be a little bit more sort of brownfield orientated, so we don't actually have to wait from signing a deal, wait sort of 3, 4, 5, even 6 years before we actually open a hotel. Try and get the mix where we can actually do a little bit more conversion of existing hotels or step into old carcasses or convert offices into hotels, so we can actually accelerate between signing and opening, that we can actually bring it from a 4-year period down to maybe a 2-year period, and sort of pick different sort of asset classes to try and convert into hotels.
Okay. Xander, you're looking at it from a different point of view. Xander's like me, a consultant. And talking with your hat on, looking at it from a funding of projects and also transactions, is the word caution in your vocabulary when it comes to what's going on at the moment in hotels, hotel deals?
Yeah, I would say certainly on the transaction side, there's a fair amount of caution. There's a picking up in liquidity because there's better quality assets coming to market now than there was a few years ago. If we talk about development specifically, 80 to 90% of all development of hotels in Africa is driven by local promoters. So they at times they have a return on investment type of goal. At times they don't, and they're building a legacy asset for the future. So their caution needs to be put into perspective in terms of that their investment horizon may be much longer. But for sure, it's challenging out there at the moment when it comes to hotel funding. When we talk about debt on hotels, that's still very much off the balance sheet of the promoters. Single asset lending, especially for development, is very difficult right now. So I would say, yeah, there's a certain amount of caution around the industry. A lot of the more mature hotel markets are seeing oversupply. The pipeline that you ran us through and the large amount of openings we've seen in 2015, 2016 have meant that some markets which were very much ripe for development have, through 2 openings, have all of a sudden become oversaturated. So I think in that sense, people are understanding how pronounced supply cycles are in this part of the world, in the hotel space, a lot better. So for sure, there's more caution today.
Dr. Martin Davis from Deloitte was saying this morning that you could really take Africa and just take a line from north to south and split Africa into East Africa and West Africa and the kind of the central bit in the middle, which he wasn't very polite about. But in terms of the West Africa, East Africa split, he in my opinion, quite rightly was saying a massive difference in sentiment, returns, everything between the two. Are you experiencing that, again, from your funding transactional point of view?
I'd say in East Africa, the capital markets are much deeper. So there's a much bigger pool of regional capital that likes hotels, that is able to transact on hotels, that have transacted on hotels before. South Africa, of course, is quite a separate story again. There's a dominance of owner-operators that have very strong balance sheets to leverage off. West Africa, I mean, we were just involved in a large transaction there. Yes, there is money around doing hotel deals, but certainly it's a lot less mature than East Africa at this stage.
Okay. One of the slides I brought up there was about actual openings and the fact that back in 2014, only 25% of the rooms that the chains thought they were going to open in 2014 actually opened. The average over 2014 to 2016 was only 38% of the hotels expected to open actually opened. As I said, Carlson Residor, Hilton, they don't invest in hotels, they don't build hotels. So whilst the trend has been great, it's gone from 25% in 2014, 35%, about 46, 47% last year. It's still not happening as you, as promoters of your brand who are looking for other people to build you hotels. It's still not happening to the extent that you expect it to, and I'm sure to the extent that you want it to. Now, so two questions to you guys. Why? And what can you do about it? You've got the microphone, Andrew.
Well, we obviously sort of identified a couple of years ago that we were signing deals and not getting hotels open. We need to look at how we could actually assist owners to get the hotels open. So we actually internally had something called a Pushpull Program, which is where we would actually identify hotels that if we actually played a much sort of more hands-on role from a development point of view and from a technical service point of view, we could actually come in and assist the owner in actually getting an existing hotel sort of across the finish line and get it open. And for any new hotel since 2014, we won't sign a deal unless there's actually a turnkey design and build contractor on board with a fixed price, fixed time contract. So, and we've really done that because we've recognized where we've been able to open hotels is where we've actually had the correct contractor on board, where the actual responsibility sits with the contractor on delivering it on time and within budget. If he's late or there's a cost overrun, it's actually sitting with the contractor and not with the actual owner anymore. Because most of the hotel owners in Africa, as Zander mentioned, are they're first-time hotel investors. They don't necessarily understand property development as such, and often they were initially sort of assembling themselves with the wrong team, so they weren't getting the right team on board to actually execute that hotel sort of on time within budget, be it from an architect all the way through to a QS to actually selecting the main contractor. And what's also happened because of other markets sort of slowing down, you've had contractors which are now prepared to actually do design and build sort of contracts and actually have a little bit more risk sort of put on them. So we've seen, because of that, there's been a better quality contractor on board and more responsibility on the contractor, that you're able to get hotels to actually open a bit earlier, or us literally where we actually appoint a PM, or we actually put a PM on our which we pay for, actually goes onto site and actually sits in the hotel and actually assists from a project management point of view or from a procurement point of view to get hotels which we think within, if we step in and play an active role, within 18 months we could actually get that hotel open.
So you're making it a condition of your involvement. You're not an investor, you're a supplier of, you're a service supplier. You're saying that you won't get involved unless there's a design and build, turnkey design and build contract in place.
That's correct. So it's the same as we would also, from a debt funding point of view, we want to understand, so in our due diligence process, if we're looking at the debt structure, there's a certain milestone we're going to meet that if there's too much debt in the project, we're also not going to go ahead with the project. So we know that if we have a design and build contractor on board, it's more realistic if they say it's going to take 36 months to build or 30 months to build, the likelihood of that happening is very, very high.
So
Because-
you're saying that sorry, I'm putting words into your mouth, but I will. You're saying that the contractor is one of the main reasons for delay. And that's why you're doing what you're doing.
Not that the contractor is necessarily always the reason for the delay. It could be the drawdown from a funding point of view, which has affected the contractor. But if you set up your project up front, where you go into a civil book contract, where it's the funding, there's a much clearer funding structure. Your first down payment on a civil book contract is a lot higher than a traditional contract. The owner has got to make sure he's got all his funding in place. From a debt point of view, the actual drawdowns from the bank can actually go straight to the turnkey contractor, not necessarily to a promoter. So you're structuring the projects to run a lot smoother.
Okay, Mike, same question. Why are there so many delays, and what can Hilton do about it?
I'll focus more on the second part of the question. I think I covered a lot of the first part earlier. I think we're just focusing on trying to keep it simple, yeah? So new opportunity, yeah? We encourage an owner to get an expert like yourselves on board, market study, get a good architect on board, and get your operator involved earlier. We're not going to be that prescriptive and say you must have a design and build, but we'll support that owner to develop the project. Now, there are a lot of things outside his control, but we're reinforcing our project teams, and we're also reinforcing with our brand performance support teams. We see that there's an opportunity for franchising in this country to grow. We believe we're a very sophisticated franchisor, and we're reinforcing those teams to support that growth. One of the key initiatives, and when I come back to being simple, it's doing the right thing in the right market. Now, I see significant potential all over Sub-Saharan Africa for our Hilton Garden Inn brand. It's the one standout brand of our portfolio of 8 that we're growing in Africa that I think is going to see significant growth.
And you've got quite a special development model for
And that's
that.
what I was just coming to. We have a strategic arrangement with CIMC. They're the largest container shipping company in the world. And we've been working with them for a number of years now, and particularly with our focus service brands. The guest room is actually prefabricated in a factory in China, shipped in a container, and then erected on site. Now, 4 hotels have already opened with this system in the UK. Another 12 are under construction, and we're just about to go under construction at Ghana Airport with our Hilton Garden Inn project there. So when you look at the market and the advantages that brings in terms of logistics, in terms of program, in terms of workmanships, I think that's going to mitigate a lot of the issues that we've experienced in the past and that you've talked about today.
And that'll be the first hotel in Africa, I think.
I believe so,
They've
under
built that one.
prefabricated, yeah. So
Xander-
certainly over the midterm, it's where I see the growth.
Okay. Xander, your experience is mostly South Africa, I think, in previous lives as well as that. Is what you're hearing about delays, does that ring true for South Africa, or is it so different here?
It is so different here, for sure. I mean, South Africa, also Indian Ocean, where we're quite active, where you have a lot of owner operators, developers that have done many hotels before. Absolutely, you can get your hotel done, completed within 18 months. That's really not a challenge here. You've got great contractors.
8 months.
18 months.
18
months.
Okay.
I mean, when we talk about modular construction, you can probably get it done in 12 to 14 months or so. Not that has been done much here before. But yeah, absolutely, this is the easiest environment to be developing in.
Okay. All right. Thank you. Xander, you used the word oversupply. Again, we heard that a lot this morning, talking about oversupply in retail and office specifically. And in those industries, oversupply in retail means you can't get tenants, and same at office. You can't get tenants for your space. Oversupply in hotels is a bit more difficult. What does oversupply mean? But let's, okay, just to simplify it, we've got too many hotels and they're not trading terribly well because demand doesn't match up. Now that could be because too many hotels have been built, or it could be like Lagos, where there have been so many external shocks that demand has decreased and decreased and decreased. And we've actually had very few new hotels built in the last 2 or 3 years. So let's stick with the too many hotels have been built. Do you see oversupply in any of the markets in Africa? In terms of, you saw the data for openings in 2015, 2016, quite a spike, and Xander pointed out that there are some markets which are getting oversupplied. Are you avoiding some markets as a result now?
So there are markets right now which I think are heading into an oversupply, or areas we wouldn't look at the moment, because we think there's probably too many hotels in that market
Please
today.
name
So
names.
Kigali, I would not add a room to Kigali today. I would be cautious to go into Nairobi currently. I think Nairobi, though, is moved into being a mature city and a mature hotel market. So I think it's going to now naturally just trade through, like any big city in the world. It'll go through an oversupply for a short period of time and then stabilize.
Well, mostly they catch up
and then go
because of
into an
demand
undersupply.
growth.
And
Yeah.
so I think that's a city that will probably go into a short period of time with possible oversupply. Addis Ababa could be a market that goes into an oversupply if all the product that's been signed actually materializes. But again, if you look at the GDP growth of Ethiopia, you look at the airline network growing, it is a country that's growing. So again, I think it'll be a temporary sort of process. There's talks of Cape Town having a potential oversupply. I think that could also, if it is, it'll be for a very short period of time, and it'll stabilize again. But at the moment, I wouldn't go into Kigali is probably the biggest worry.
Yeah, I mean, you make the point. You can't just look at the pipeline data and say there's going to be oversupply. There's 61 hotels in the pipeline in Nigeria. They ain't all going to happen. Are 50% going to happen? Doubt it. So it's the actual bricks on ground that measures it. And you're right. I mean, I think Kigali, I think Addis Ababa. Mike, what's your view of oversupply?
I wouldn't
in
disagree
Africa?
with those. I mean, certainly Nairobi and Addis, if everything happens, potentially the short term there could be supply.
Nairobi's actually got a lot under construction.
It does, but the market's growing.
Yeah.
And there's just been very decisive elections and relatively peaceful. And I think in a month's time, Nairobi will take off again. So these markets do change quickly.
Okay. Yeah. Yeah. I mean, I've been told about oversupply in Lagos ever since I moved there in 2003. It hasn't happened in terms of too many hotels. It has happened because of a huge crash in terms of demand, going from 70-something% down to 40-something% because of the economic crisis that the country's undergoing. Time for questions from the audience. Any questions from the audience? Oh, hello. Shall we have a microphone? It's.
Maybe, gentlemen, that was a great presentation, by the way. I want a copy of that one, if you don't mind. So I'm an American. I'm a developer of hotels and service apartments in Zambia at the moment. And it was really interesting to hear your views on development. So I approach it as a developer. I started an operating company called the Urban Hotel Group. And basically what we do is we build international standard value product. $100 a night, do long stay and short stay. And the one thing I'm from New York City. I used to be in the restaurant business. And you go around New York, and the one thing is that anybody will say if you walk through Manhattan is they don't need any more restaurants. And a lot of the conversation about hotels is about what's coming online and how many rooms are out there. But I'll tell you a niche that we've discovered, because it took us a while to get started. You know, we do a lot of people in the capital markets. They were like, guys, just go do one first. And nobody wants to be the guy that takes the flyer. But when we did one, we decided that it was going to be something that I'd be proud of if it was on Miami Beach. In other words, there's a lot of product out there, but it's expensive. It's not very cool. The bar is not very happening. And these are really low bars. So our whole idea was, right, let's just stay at the value end of the market, and let's do stuff that will be inspirational, aspirational, great common spaces, great public spaces, addressing the whole millennial kind of development in hotel markets. In fact, I saw the Hilton True developers package, and contacted Hilton and said I would do a couple of these in Africa, and they were like, you know what, give it 5 years. We're kind of busy in the United States, but that is exactly where this market needs to be, or where I see the opportunity. I see it all around. We've got 2 hotels open in Zambia, another 3 under development. We've got sites in Tanzania, and we're looking in Kampala and a bunch of other places. And the exciting thing from a developer owner point of view, operator point of view, is that I don't see anybody touching that space. Everybody's kind of going for the higher end, the $250 a night, the $200 a night, the $300 a night. Our clients we have a store, as we call it, in Ndola. And our clients are corporates. I mean, Zambia Breweries has already stayed with us 500 nights. We've only been open 5 months. We get people like UNICEF and UNDP. Everybody wants to save money, but they all want to be at the best bar in town. And so that's where I see a great opportunity. I'm super excited about the long and short stay space, especially at that value sort of end of it. And hopefully I'll be coming to one of you guys shortly so you can buy all 15 of the ones that we've built over the next couple of years.
Well,
Great,
True by Hilton has
thanks
got
for
off
that.
to a fantastic start in the US. The first one opened about 6 weeks ago, and there's already 290 in the pipeline. But the US is a completely different market. It's highly segmented. Hampton has been the most successful brand, and that's almost saturated in the US. Our focus at the moment is to grow the portfolio. We have a focus with Hampton just in South Africa. It's a much more mature market. And it's essentially because of scale. It's because of volume. So for most of the markets, I see the mid-market Hilton Garden Inn as being the core opportunity. We're constantly refreshing that from a food and beverage and a lobby and brand experience. But over time, yes, Hampton and maybe True, we will at some stage take True internationally. But at the moment, we've got 8 brands that we're growing strongly, and Hampton's been very successful in Western Europe, and I see it really taking off in South Africa soon. So that's us.
I just want to concur with you that I think the extended stay product is an exciting space within Africa. And we have 6 extended stay or long stay sort of apartment hotels. And we sort of see exactly the same as you, that there's, in certain markets in Africa, there's a big demand to have a mid-scale sort of extended stay product. We as a company don't have as many brands as Hilton, so Park Inn by Radisson actually can be a Park Inn by Radisson extended stay product. The same with Radisson Blue. But good luck.
And the returns to investors on extended stay are exceptional.
I mean, just to comment on, I think it's absolutely the right place to be, in terms of budget, good value. I think the big challenge is how do you reach scale, especially for the operators, because there's a massive machine behind them, and that's I think where they might shy away from the select service or whatever you call it, the budget space. So if you can find a way of creating a platform where you can effectively operate and deploy your capital and roll out, of course you're going to be creating an excellent portfolio at some stage for these guys to acquire, because then they don't have to do all the hard work themselves by starting off with the smaller units.
Thank you. Any other questions for the audience? Gentleman here.
Hi, so I'm from it's a loaded question, but I just, full disclosure, I'm from JLL, but it's not a loaded question for Xander. So I thought it was a really interesting panel discussion. Is there anything, and particularly what I do in research is I'm looking increasingly now at where we are in the cycle and at external factors, either headwinds or tailwinds, that you see that stand out. I mean, it could be just one example. I mean, Xander and I were talking particularly about currency issues, you know, and QE and stronger dollar or weaker euro. What does that mean? It's an open question for the panel. It doesn't need to be a particularly long answer, but is there something that I might be missing as an analyst that is going to unwind over the next 12 to 18 months that you think is driven externally, that we don't have a lot of control over, that we should be aware of? And I said either a headwind or a tailwind.
Good question. Thanks. I guess, I don't know. I mean, if we're talking purely about trends, I would say, you know, development funding has become a lot more difficult in the last 18, 24 months. Don't see that getting better easier in the short term, unfortunately. I would say the good part is liquidity is picking up, so exit opportunities are becoming easier. But it's more driven by regional capital than by international capital coming in. I think a lot of that's still sort of sitting on the sidelines. And maybe another trend to watch is certainly, aside from the big growth that the big brands have got, you've got some great, you know, smaller guys, whether it's the Onomos, the City Blues, you know, the Urbans, who are focused perhaps with a product that can in certain markets be more appropriate for the demand base, development costs which are lower, operating costs that are lower, that have actually got some pretty good development pipelines at the moment. So I'd say in the medium term, those smaller local and regional guys are good ones to watch to see how they're able to combat the massive distribution that these sort of guys have behind them.
Xander, just before you pass it on, sorry, perhaps you could, there are maybe one or two people in the audience, forgive me if I'm wrong here, but they may not understand why hotels are so much more difficult to fund than, say, an office block. Perhaps you could just explain the structure of a hotel with a branded operator.
Sure. I mean, the biggest issue clearly is the lease. You know,
That's,
on all other asset classes, you have leases in place which are easy for banks to discount back, to take a view on, you know, what the tenant default risk is, what the strength is. Whereas with the hotel operation, generally speaking, you have a management contract with expert brand managers who come in, but ultimately the owner is fully exposed to operational earnings. You know, so as a result, when it comes to lending, you know, so is the financier. So when they look at it and say, well, you know, which balance sheet am I going to be looking to when the operation doesn't perform as well? You know, they need recourse from another source than just the hotel itself.
thank you.
I think just going back to sort of answer your question, I think from an African point of view, look at sort of tailwinds or sort of headwinds. We really need Nigeria and South Africa from a leadership and from an economy point of view to turn around. So those are two. So if you take the four big economies in Africa, it's only really Kenya that's ticking on at the moment. The others are all just sort of surviving. And Africa needs those economies to sort of come back, and they're all very commodity based economies, and there needs good leadership in those economies. So when Africa 5-6 years ago Africa was rising, and there was so much talk about Africa, those economies were all thriving, and we need that to happen to really see a big brighter future.
Yeah, I wouldn't add any more to that. I agree. The key economies as a basis, hopefully with Kenya now, that's going to consolidate and drive the eastern side forward, and it's just political stability. And we've seen decisive and generally peaceful elections this year, which is a very good positive.
Okay, I got time for one quick last question from the audience, if there is one. No? Yep, I've got one.
Hi, Terry from Profica. We've been exposed to a couple of hotel projects across Africa, and I think the difficulty in getting a hotel from a signed agreement to delivered on any of the sites is really one of the key issues is funding, which I think we've touched on, and also just running the process through. So the project management aspect of going through the design process, making sure the budgets are correct, selecting the correct contractors is all part of the process in delivering a hotel once you do have the funding in place. And the question then to the operators is there an opportunity for operators to perhaps bring in some funding, not necessarily from their own operations, but through their network that can assist the owners to take care of the shortfall in funding? Because we typically find a lot of owners are sitting at maybe a 20 to 30% equity, and that making up that shortfall is where a lot of projects just never come off the ground. And then during the delivery stages they put a lot of emphasis on the maintaining brand standards in design and specifications, and perhaps there's something on the project management aspect that can be brought in to, as a KPI for the owners to stick with, that they can maintain what the program is. Because a lot of operators, we've said, are first-time developers. They like to do things on their own. They want to go and buy their own chairs, their own furniture. They want to touch the design during the process. All of these things just add to the complication of what should be a relatively easy process.
Can of worms opening there. Can we just have a quick answer on
Just when I thought we'd get away from it.
funding? Sorry?
Just when I thought we'd get away from it.
Yeah. Just operator funding.
No, it's not our core business to certainly take an equity stake or a part equity stake. We will selectively look at maybe a key money contribution market by market, project by project, and contribute to property improvement plans for a conversion. But it is more of a contribution than any physical stake.
From Residor's point of view, we actually have a fund called Ranaut, where we've actually invested $50 million into Africa, into hotels, to try and select sort of cases, bridge that gap where there is a funding shortfall, be it from a mezz debt point of view or from an equity point of view. What we've also been able to do, because sometimes our funding structure can be expensive, we've been able to bring in the right contractor who's also prepared to sort of bridge that gap from a main contractor point of view. So we'll work with the owner on trying to sort of bridge that gap. And obviously, it's from a project management point of view, we're not sure about Profica. No, if we have the right team in place up front, we shouldn't have those problems. It's when we inherit a project, when the train has left the station, we're the last person to join as the team and everybody else is in place. That's when you end up having the problems you have, that the owner thinks he's saving money by trying to do his own procurement, where he's actually going to spend more that way. And then we've got to go into this Pushpull program, which I spoke about earlier, where we sometimes have to bring a PM that's at our cost to actually try and assist in actually getting that hotel across the finish line.
Thank you very much. Time's up. Thank you very much, everybody, for listening. My apologies for waving the microphone around at the beginning. Sorry about that. If you would like a copy of the report that was extracted from, just give me your card and I'll happily email it to you. Leaves me to thank very much my panelists, Mike Collini from Hilton, Andrew McLaughlin from Carlson Residor, and Xander Ninans from JLL. Thank you very much indeed.